The button.
I clicked it.
All right, happy Tuesday, you guys, and Merry belated Christmas for anyone joining
Yes.
us live,
And soon
and Merry
Happy New
belated
Year.
or happy belated Hanukkah as well.
Today, welcome again, everyone. Today we are going to be speaking with the founder and CEO of Invest on Main Street, Patrick Rhymes. Welcome, Patrick. It's very nice to have you here.
Glad
Um,
to be here as well. Thank you so much.
and you have quite a lot of experience and a little bit of everything in real estate investing. So, anybody who has questions, post them in the chat. We will definitely get to your questions. This is a very casual format, so let's
That's for
as
sure.
really.
Keeping it raw.
So let's go ahead, Brian.
Well, Patrick, welcome again. And I always like to start when we have guests on the show to ask them just how they got started in real estate. The 30,000 foot overview of what got you into real estate, and then we can talk a little bit about what has changed and evolved for you over the years.
Sure. Well, so I definitely wasn't born into it. My I started geek early on. I did mechanical engineering.
All
I
right.
got a job at a machine design automation firm. We did custom equipment for manufacturing automation. Made a lot of really cool stuff. One of a kind, custom machinery and robotic systems. And the owner of the company I was working for, who still invests with me today, and I actually bring him up in my book and pick on him a little bit here and there. We're so good pals. And he suggested that I should consider investing in real estate as much as I can and as soon as I can. And he never regretted his real estate investments, and only that he didn't do enough. And so I saved up. He's like, well, while this engineering is cognitively rewarding and fun, it's volatile and risky, and especially the high-tech space we're in, and you should put your eggs in some other baskets. And so I did. And I saved up every penny I had, dumped it into some high returning, what I later learned were higher risk investments, lost it all through 2008, 9, and 10. It just raked me over the coals.
Were
Circled
those direct property investments? Were you buying rental properties, or did you invest in like syndications, or what were you investing in?
residential pre-development.
Oh
So a little
wow.
more.
Oh yeah, that is higher risk.
Well, I wanted to double my money every 2 to 3 years. So, I didn't realize at the time what a recourse loan meant, and signing on the loans, and how they can come after you, and you're kind of cross collateralizing everything through those investments. So they raked me over the coals. And banks came after me and did debt forgiveness, had to pay taxes on that. But it was that early on learning experience. Certainly, I dove back into my high-tech career, got a master's in engineering and business. But when I started making substantial income again, I realized I was like, well, I got to get back into this. I can't work until I die. I've got to come up with passive income and appreciation. And let me do real estate, but completely differently this time. So that's what led me to much lower risk investments, recession resilient markets, existing buildings, not land with nothing on it, and cash flow, and Robert Kiyosaki and Rich Dad Poor Dad and all that stuff.
So, post Great Recession, what was your first real estate investment? When you went back into it, in round two.
Mm-hmm. Yeah, well, a lot of the data that I looked at back then, I still look at today. I was looking at for recession resilient markets, locations where we had seen in prior recessions them be very resilient, either sustain their value or rebound quickly. So not the Phoenixes and Tucson's, Las Vegas's, or Orlando's, but more the Sun Belt, like the Houston's, for example, where it just rose steady growth and in 8, 9, and 10 leveled off and then started going up again. Whereas the other markets, right in the rest of the country, did 6 to 12 year swing just to break even, right? And a lot of the investments. So I look for specific markets that being a little bit of an analyst myself, I have a bunch of different factors go into it, but I'm looking for specific markets that have built-in insulation through diversified employment in recession-resilient industries, and assets within those markets that tend to fare fairly well in the recession. So Right now, it was to your question, Brian, single family, 3-bedroom, 2-bath, and building a portfolio, buying distressed, but renovating quickly to cash flow with known comparables in a proven market. And now it's traded up to large 200 to 300, 20 to 50-year-old multifamily apartment buildings, which are in recession resilient markets, workforce housing, where people tend to move into these housing options in recessions because they're a lower cost option. So that's how that progressed.
Well, I love that, and we went from 0 to 60 very quickly there. So I want to rewind for just a moment. You said you got back into real estate investing by investing in single family rental properties and renovating them. How did you make that transition from buying single family rentals to buying apartment complexes? Because that's a big gap to leap for a lot of investors.
I got married. I'm not
Married rich, huh?
That destroyed my single family because I was working hard. I've always been a hard one. I was working full time, getting 2 master's degrees. I was working full time, flipping or to myself, buying and holding and renovating single family homes, but out of state. I'm not a Southern California, and I was doing this in markets far away. It's a lot of work, and I was moonlighting it essentially, right? And it made me impossible to date for a while. I was trading a lot of my family, friends, and hobbies, valuable time for my investment portfolio because I was working at an extremely demanding, high-income earning job. And then I was doing an extremely demanding buying, finding, renovating, refining, holding, buying, finding, distressed investments, which was working, but it was exhausting. And when I met my wife, I was there. She was there sitting with me at the coffee shop for the very last closing. And, and I was like, this is it. It's over. We're getting married. So I'm not going to do this for a while. It took about 2.5 years. We got married. And then I said, on the other side of this, I'm going to go at this a very different way. I'm going to do a financial institution, private equity firm. I'm going to partner up, and we're going to do even lower risk assets in better markets, but with partners that have decades experience. And we're going to trade up 1031 exchanges and then started syndicating. That took about 2.5 years for me, the analysis paralysis in me, the engineer, to get enough stuff in my head here, but pushed all the hair out of the top in order to feel like I had a handle on the multifamily. And I'm still learning a lot by working with people that are smarter and more experienced than me.
And how did you go about looking for that? I mean, because you said that you really, you read and whatnot, but did you seek out people to mentor you and that kind of?
Yeah. So I downloaded all kinds of books, webinars, attended conferences, started meeting people and networking, started learning how to analyze deals with Excel spreadsheets, call it underwriting. We started attending online meetup groups like Slack and my local RIAs where people would review each other's analysis. And then I started meeting bigger players, and I said, hey, I started meeting brokers and getting on broker lists and getting deals and learning how to analyze them. And I started presenting those when I got better at them to different people who have had a lot of experience in this asset class. And I'm like, hey, I know how it works in single family, but this is a completely different ballgame in large multifamily. And then I would get feedback like, hey, here's all the reasons this sucks, right? And but by the way, this one's good, but not good enough. And a lot of that happened for a while. And I traveled around, looked at a lot of deals, and walked away with my tail between my legs, until finally a partner said, yeah, let's work on one together. And, let's make it happen. I think it was just a lot of, my book's called Persistence, Pivots, and Game Changers. I think it was a lot of persistence, and finding what value they were looking for and kind of matching that with my skill set.
I love that. I just love, my father always told me persistence overcomes resistance. And so many people give up so easy. And I think I learned more with some of the mistakes I made early on than, yeah. So anyway.
I agree 100%. Yeah. I'm a product of making mistakes, right? I did my analysis paralysis, but even then I stumbled quite a few times, but now I've found a path where I think it's low risk for myself, both in real estate and and our diversified energy funds, which we have to help people diversify and de-risk their portfolio outside of real estate into another essential need, housing and energy, right?
Awesome.
So you became a co-sponsor. You partnered with existing real estate syndication sponsors and became a co-sponsor on these deals to what, on the raising money side of things, or also on the finding deals, managing deals on that side of things as well. So how did you go about that transition, becoming a co-sponsor of real estate syndications? And by the way, for the audience, we'll add a link to an explanation of exactly what real estate syndications are if you're not familiar with that term.
Yeah, so when I started trying to buy properties myself, I knew I didn't have all the money that I needed to buy these large assets. So I went from 3-bedroom, 2-bath all the way to 86 units. And my calculus was it had to be above 80 because by the time there was nothing between that, the longest, most stable assets for appreciation is 3-bedroom, 2-bath. Everything in between that is mucky in my world because you're not commercial until you get above 5, but then you can't get good debt until you get above 20 or 30, and then you can get non-recourse debt, but then you can't get on-site property management, which is part of the hair pulling that went on early on until you get to 80. Right. In most markets, you can get economy of scale, you can get non-recourse debt, the assets produce enough income, they're low risk, you can get on-site property management, leasing, and maintenance, so they're calling you, you're not having to chase somebody all the time. And at that point, you can enforce appreciation through renovations at scale, and everything begins to pan out again to a metric, which I felt was like that leap. I said, well, if I'm going to do single family, I'm going to stick to this path. Nothing made sense. So in order to get to this higher asset class, to play ball in the right way, I had to work with people that, first of all, had decades of experience. And so I traveled around to these markets that I decided were the ones I wanted to invest in because they had all of the check boxes of recession resilience, cash flow, landlord friendly, and all this. I said, I'm going to set up business. I'm going to set up business in the right place. I met people that had been operating and working in those locations where I felt like, hey, this is the right. A lot of other companies are moving to these locations I'm investing in too. So I'm not the only one that understands legislative friendly business, cities, but so I started meeting them, and I started talking to the brokers, getting deals, underwriting deals, and bringing deals to these people. So I got into the business as a deal finder and an analyst. Like that's really where my strength was, right? And when I that's funny because how it played out was on my very first deal, the guy that I was talking to, and I was like, and this was like, I had kind of had semi-partners with 6 people where we had tried to make things happen. And then for one reason, the risk profile, I'm very risk averse versus theirs, or very much more aggressive, or whatever reason, those didn't play out. And all of a sudden, one of them goes, hey, look, this 86 unit deal is a great deal, but I'm too busy. I've got this 100 unit deal, this 200, this 300 unit deal, and I don't have time. Turns out, he didn't need deals. He didn't need capital. He just needed somebody he could trust. He needed his nights and weekends back. And after showing up as a hard worker for so long and really getting nothing, and I didn't even ask him like, hey, what am I going to get in terms of partnership percentage for bringing this to you? In fact, not until after we closed the second property did we ever establish my position in the partnership. So I just came bringing value. And I let him, suggested but I let him draw me into what he needs. What he really needed is to be able to sit down with somebody over a 15, 20-minute Zoom, hit record, tell me everything that needed done and how it to be done, and then me just come back and get it all done, and present it all to him, and then do it again and again. And then after the first deal happened and I had done, he was like, well, we got another one. Can you help? We were living in Hawaii at the time, and I red-eyed out overnight, landed, right, and did the due diligence, walked the units, and it's a lot of nitty-gritty, and it's a lot of work. And meanwhile, I was still juggling my high-tech career. So I was moonlighting it again, but with the end in mind, right, something that would scale. And then the third deal actually happened in parallel with the second deal. So it was about figuring out what is needed by the partners, showing up and leading with value. And to me, that is what got me into the space. The grit, just getting the work done and doing it with the right people.
Well, one of the things that I love about what you just said, and it's been a recurring theme that Denny and I have heard over and over again, is that it's really those relationships that can build your real estate investing career, really any type of career, right? But to build those kinds of relationships with the kind of people that you want to be in bed with, you really do need to bring the value first. So I love how you approached that. So tell us, what kind of deals are you working on now through Invest on Main Street?
Well, so we have over a 500 million portfolio at this point. And you asked the jobs that I'll do on deals. Sometimes I'm helping to find the deal, raise capital for the deal now, which we now have an educational platform that helps to educate investors on alternative assets. And if you look at my passive investor guide on my website, which is a free download, it talks about the middle class, the high income earners and the ultra wealthy having 7% in the middle class in alternative assets, 25% for the high income earners, and ultra wealthy is 50%. So the problem is nobody has any idea what alternative investments are. They're only educated in their 401ks, SDIRAs, or their financial planner, which all puts them in one investment in the stock market, all similar correlated assets that rise and fall together. Maybe they've graduated to real estate, but then they're just in a bunch of different kinds of real estate. Some safer, some not so safe, right? But then you can lose it all there too. I did it. I think my assets now will survive another 2008, right? Now, that's the whole reason I'm doing the workforce housing that I'm doing. But it's important to be in other non-correlated investments. Ones that, right. So you not necessarily the search for the lowest risk deal, but the lowest risk portfolio, having diversification across those asset classes. And so Invest on Main Street's really working on building out those non-correlated or investments that give you options to invest for tax advantages, recession resilience, cash flow and appreciation, so you can accelerate your retirement and watch your legacy grow through retirement. And so that is both by multifamily apartment communities, as we've discussed. We have diversified oil and gas investments, which provide even better tax advantages than real estate. In fact, 75% of your investment for most of our investors comes directly off their W-2 income. So their taxable income directly lowers. Even in real estate, it's got to be passive income, and this is active income. Right. Any income, your AGI lowers. It's incredible. Plus, you get the monthly passive income and appreciation in a completely different asset class where it's half oil and half gas, diversified across many states at scale. Like we have multifamily, lots of units. Well, this is lots of wells. So a fire in a unit is not going to cause the multifamily building deal to collapse. A dry hole in a well is not going to cause the economics of our diversified funds to collapse either. So we get those, and then we have in next quarter we're launching a cash flow fund, and that's affordable housing, and it is a preferred equity fund paying out 12.5% immediately after investing. So it provides for a tax advantage cash flow, and I think that's probably I'm doing that because what's needed most is cash flow right now with interest rates rising. What you see is people are searching for it. A lot of the deals that were cash flowing are no longer cash flowing. And next year it's going to be even harder. And so we're doing a cash flow fund to help people get into that cash flow quadrant.
Well, I love that. Denny and I talk all the time about diversification and how you want to be exposed to many different assets that are not correlated. I mean, we have money in stocks, we have money in real estate, and many different types of stocks, many different types of real estate, and some alternative assets as well beyond real estate. So with Invest on Main Street, do you allow non-accredited investors to participate, or is it only accredited investors who can invest with you?
Yeah, so what's unfortunate about that whole thing is I wouldn't be able to tell you about my investments if I allowed non-accredited investors. And so kind of like the chicken before the egg thing, how can I make a difference in increasing the financial IQ of America if I am allowing non-accredited investors, which doesn't allow me to talk about my investments openly. So how can I get out there and say, hey, there's all these alternatives for everybody to invest? Unfortunately, the SEC, if you do that, says you have to only work with accredited investors. So I have always ever been, I would call it a Reg D 506C offering, which was accredited investors only. I have friends that do Reg D 506B, which allows for non-accredited investors. And so while I'm happy to speak to you if you're not accredited, if you don't make the income or net worth, I would like to help you along your journey. Not necessarily through my company. I could pass you along to other investors that have friends and family type filings. If you create a relationship with them, and then on their next deal, you can potentially invest. I don't get anything out of it, but I want to make sure that I'm helping at this point to grow that financial IQ, get people started on their journey. But yeah, unfortunately, because I'm here talking about it, then you know that I can't allow non-accredited investors in my deals.
So you also talked about tax advantages when we were talking about some of the investments that you pursue through Invest on Main Street. And by the way, we included a link to that in the comments for anyone who's following along in the audience. And you know, in your pre-interview notes that we were passing back and forth, you know, you mentioned that you mentioned some tax advantaged ways to invest in real estate as being a specialty of yours. So talk to us for a minute about self-directed IRAs and any other kind of advanced tax strategies that you can recommend to real estate investors to help them make the most of their tax advantages.
Sure. Yeah. So I actually have some articles in Forbes. I mean, Patrick Grimes Forbes on 1031 exchanges, or Patrick Grimes Forbes on investing with your self-directed qualified plans that kind of outline some of these. I write for Forbes, these strategies. But I don't do a lot of that sort of more very creative infinity banking and all that. I'm more just kind of down the straight and narrow. Here's the old school tried and true paths. Those are qualified plans. Like if you have a past employer 401k and you're sitting on it in the stock market and your wealth is there, well, we can help you roll that over into a self-directed variant, or a piece of it into a self-directed variant of that same plan, which allows you to directly invest into our deals. Same thing with IRAs, or Roth IRAs. Those all can be rolled over into plans. That allows you the ability to continue to grow. And when we sell the property, you don't get hit with capital gains. You can reinvest the entire amount into the next deal. It's a pretty powerful way to very quickly diversify what's traditionally in stock markets. And the reason why only 7% of the middle class are in alternative assets is because they think their retirement plans are trapped in there. 1031 exchanges is, I mean, it's incredible. It's probably the most powerful wealth building tool available to Americans. And I think what happens is people get to the point where they've graduated to an IRA, maybe 401k IRA, maybe a stock portfolio, they're day trading, maybe a financial planner. And then they're kind of like, oh, now I can do real estate. I can buy a rental property, right? They're like me. I was there and I was buying these and I was signing on the loans myself, and I was struggling to moonlight it, trade all the time away from my hobbies. I didn't realize the risks I was taking. Talked about asset protection a little bit, and I lost it all. Well, because I was trying to be active, I wasn't doing it with experience. I wasn't doing it in the right ways, and I wasn't doing it efficiently. And so I had just these rentals. Trading those up to larger apartment buildings is where I was able to get a return on my equity, which is consistent. I was able to get on-site property management, lower risk deals in better markets, bringing on partners to work with. And so you can do the same with your rentals. A lot of our investors they're dealing with landlords, tenants, toilets, trash, and that whole thing. And they'll call me up and say, hey, Patrick, look, I got to get out of this. And I have investonmainstreet.com/1031. I have a whole guide on how we help people take their rental properties, trade it in with a qualified intermediary, and then they can invest without paying capital gains directly as a partner into our large multifamily deals, and next year also into our oil and gas portfolios, and immediately start that cash flow and appreciation as they have a whole team of people with decades of experience now fully managing it. I mean, they have no job. I mean, we have regional and area managers. What are you going to do, right? You can kick back, enjoy your golden years in a safer asset, in a safer investment that will continue to keep the velocity of your capital high through 1031 exchanges. And so that's something that I always recommend.
Well, that's interesting. That's something that we don't hear people talk that much about, is selling off your direct property portfolio, your rental property portfolio, and then rolling those proceeds into real estate syndications through a 1031 exchange. We're getting into some more advanced tactics here, but I'm glad to hear you talk about how that's both possible and profitable, because again, it's not something that people talk about very often. So. You also, I understand that you have some expertise on asset protection for real estate investors. Do you have any, and I know that's a whole complicated conversation in itself, but if you were to share one or two of your best asset protection tips for real estate investors, what would they be?
Yeah, well, when you're talking to somebody who's lost it all one time, so that already was, doesn't want to do it again. I wish I had a better reason for why I've learned a little bit about asset protection other than I've lost it all and learned the hard way, right? But if we go back to the single family investor question, and if you type in Forbes, Patrick Grimes, asset protection, I've got articles where I map out the thought processes behind the mindset of sort of the single family owner versus an investment portfolio in larger commercial assets and syndications, right? Where you're a limited partner. When you buy a single family home, for example, you're signing on it in your own name most of the time. Right. And if you're getting favorable loan, you're getting favorable debt, right, loan, then you're signing on your own name and you're signing on the loan because they're looking for your credit because the building doesn't cash flow. It's not a low enough risk investment for the bank to say, no, we'll just take the building, right?
Right.
Well, our larger apartment buildings are. In fact, above 80 units, we have no problem. They'll sign on the collateral. They'll take the building for collateral, not me personally. That's what happened to me. They came after me. And so what people know, what the gurus are not telling you is that as you grow your single family portfolio, get 1 or 2 or 3 or 4, you're growing a couple things. Exposure, right? Not only is it pulling your hair out, it's going to be more challenging because you're trying to self-manage, find deals that you don't have time to find and do things you don't have experience doing and perhaps not nearby you and not the best markets to do it in, right? But the more that you sign on loans yourself, you're searchable. And I was one of those guys that would run searches to find who owned properties and for how long. And we could calculate what your equity position was through that. And then we could make an offer that we knew would pay off your debt because we did the calculus, right? Well, if some people are out there, and it happens all the time, they're trying to sum up your net worth and figure out if you're worth suing. If somebody trips and falls, they call the wrong attorney. The attorney's like, well, let me run a search. I'll see if I'll do this pro bono, right? And so that that exposure, because you're cross collateralized, like I was, meaning that they're everything you own and all the properties are all in one basket, right? You can try and put them in an LLC to prevent liability, but then the bank finds out and then call your loan due. It's bad. It's a bad situation. You're just playing games. And the reality is you don't have to do any of that. You don't have to take the time to do it. You don't have to take the risk to do it. You don't have to sign on loans. You have to put things in your own name. And you don't have to make it searchable. If you invest, for example, with me into a syndication, you're a limited partner, which means you're protected. You're not putting any more out than the capital you have in the deal. Meanwhile, we usually get your capital back in 2 to 3 years because we do a value play. We get in, we renovate quickly, and we refi out your capital. So you're even in there for a limited amount of time, but you're in an LLC, and an LLC that the bank knows about. You're not sneaking around them to try and do it like people do in single family. And in that LLC, the bank is a loan that you're not signing on either. So you don't have that legal exposure, or somebody trips and falls and they sue you.
Right.
You don't have that financial exposure where maybe the building has a challenging day and the bank's not going to come after you or everything else you own and your other investments. Each of these investments are in their own islands. They're in the separate entities. Now, that means they're protected from each other. They're not cross-collateralized. Right? You're protected from them. If somebody trips and falls or the bank comes due, you're fine. But if you put them all into entities like I do, like Wyoming, I use Wyoming, Nevada, or Delaware. If you hold all these assets in one entity like that, then they're protected from you. Now, what does that mean? Well, that means, say you have a bad day, you drive and get in an accident and it's fatal, or you do something and you're guilty of it, right? And some attorney, frivolous or not, comes to you and says, hey, I'm going to sue you, and maybe you have insurance, maybe they've exceeded that insurance, but then the judge says, now we have a judgment against you, list all your assets. That's how it plays out, right? Now, that, first of all, that attorney, before they even decided to sue you, they can't find any of these private placements, any of these passive investments, because they're not registered anywhere. So first of all, they're not going to add that to the pot of gold that they're seeking because they don't know about it, right? It's not searchable. Secondly, say they do, and then they're going to come to the table and be like, well, shoot, they listed all these things that are in a Wyoming, Delaware, Nevada. We can't access them because those states provide asset protection. They prevent us from forcing that person to sell, which means that he just may sit on it forever, and we're not going to have a quick win. This person, so that part of his net worth, we're just going to throw out. So it limits your exposure and not only the likelihood somebody would sue you or even find assets that you own, but it prevents them from being able to force you to sell those assets, which gives you incredible asset protection.
Yeah, and that's something that Denny and I don't talk about a ton, is how much better you're positioned as a limited partner, a passive investor in real estate syndications compared to being a direct property owner. Yeah, I mean, you have no liability whatsoever as a limited partner. Whatever you've invested, that's the most that you can lose. So now I want to be respectful of your time here. We do have a listener question that I wanted to squeeze in before we wrap up. Max Murphy asks, can you go into what makes oil and gas tax advantages better than real estate tax advantages? So, can you give us the lightning overview of oil and gas tax advantages compared to real estate tax advantages? Right.
Well, if you're investing in direct oil and gas or food or housing, because the government's relying on us to feed, energize, and house America, unlike in countries like China, where those are all government institutions, they're going to incentivize you. But the IRS specifically pointed at domestic production of natural gas and oil and said, we're going to put specific allocations for tax advantages to people that do that, because we need to increase the domestic production of natural gas and oil. So they're saying the investment that you make as an individual, if you invest as an individual, that income, that income you use to then invest, right? You made some money, now you're going to invest it, but you're going to invest it where we want you to put it. So we're not going to tax you on most of that. What does that mean? Well, for example, in my investment that's open today, if you go immediately to my website, Invest on Main Street, you log in and invest 100 grand into our diversified energy portfolio, we're going to pass to you between a 75 and 85% of your investment. So on 100 grand, maybe a 75 to 80 grand, 85 grand intangible drilling cost loss. So we're going to provide a K1, a partnership return that says you lost on paper 75 to 85 grand. Now, but you're all in at 100 still. You haven't lost anything. It's a paper loss. Now that, different than real estate, that actually flows through to offset your ordinary income. In real estate, that can only be used for passive income. And in oil and gas, your adjusted gross income or your ordinary income, your W-2, your K-1s, your bonuses, all that stuff. So if you make 400 grand a year and you invest 100,000 into our deal, we're going to take your $400,000 tax position. we're going to reduce it to at minimum 325. And now you're only taxed
Wow.
on 325. Most of our investors, does that put you in a new tax bracket as you get down? Most of our investors realize about a 30% return on their investment just from the year one tax advantage. If you invest right now before the end of the year, we're going to pass through that tax advantage when you file your taxes. You're not going to have to pay that. Immediately, right off the bat, you're going to like almost a 30% return. Then we're going to pass through 10 to 20% cash flow, which is not taxed. Then we're going to do a return of capital. We're projecting, these are all projections, of course, in the third year, and then a 3x equity multiple in 3 to 5 years that we can 1031 exchange forward, like real estate. So the aggregations are all there. The same kind of returns are all there, but with oil and gas, it comes off your ordinary income.
But now, if you don't exchange, when you do sell off those assets in 3 to 5 years, I mean, do you have to, if you don't do a 1031 exchange on that with oil and gas investments, do you have to repay those paper losses, similar to like depreciation recapture for real estate?
Yeah, so there's a couple ways to address that. Like, so for example, if we go with the scenario where you invest 100 grand, which is our minimum, and you save 30 grand, okay, in your taxes, that would be, if we pass through a 75% paper loss and you're 40% tax bracket, you'd save about 30 grand on 100 grand roughly, okay? So you're kind of all in at 70 grand after taxes, but you got 100 grand invested, right? Now you're collecting 10 to 20, or we're projecting 10 to 20% monthly passive or yearly income on 100 grand, but you're all in at 70. Then you get a 3x equity multiple on 100 grand, but you're all in at 70, right? At the end of the investment, that 30 grand of Uncle Sam's that you've had invested this entire time, you've seen cash flow from it and you've seen an equity multiple on it. But at the end, if you cash out, they're going to say, can you give me that 30 grand back? Right? You're not investing it anymore. We gave it to you while you had it invested. But but if you want to reinvest it, and then you can keep it. But we let you have it long enough to make a return on it. But now we want that 30 grand unless you 1031 it forward into a like kind. That is also a tax incentive that then you keep investing it in the way we want. We'll let that ride. Does that make sense? Huge win either way.
Yeah, so you keep earning the cash flow on it, but you don't have to repay back Uncle Sam any of those tax advantages that you received while you're on it. I love it.
Yeah.
Well, Patrick, thank you so much for joining us today. This has been a wonderful conversation. I love what you guys are doing over at investonmainstreet.com. And
can I offer my book? Can I offer my book to your listeners?
Please, absolutely.
Absolutely.
Yeah. So persistence, pivots, and game changers, turning challenges into opportunities.
Love it.
I'm here and I got hair. Before my wife did the COVID cut, the final COVID cut, right? So I tell my whole story in here. I've got truckloads of them. We give it away for free. It did make an Amazon #1 bestseller. Way cooler people than an engineering nerd on here. There's like Phil Collins, lead guitarist of the Def Leppard, Russell Gray from Real Estate Guys, NFL, NBA players, athletes. Really cool book. Lots of great stories, turning challenges into opportunities, persistence, pivots, and game changers. Investonmainstreet.com/book. Investonmainstreet.com/book. And we have a form you can fill out. I do sign them. We have somebody that sends them out to you. And be happy to offer a free, but I just need you to come up with a promo code and make sure they type in that promo code so we know who you are, where you came from, and that you're not somebody random. And then we'll get this off to you. And if anybody else wants to chat, I'd be happy to have that investonmainstreet.com/contact, and I'll hopefully get you pointed in the right direction.
Thank you
Awesome.
very much. I learned a ton.
I need your promo code. They need your promo code. So you have to come up with a promo code right now.
Spark.
Put us on the spot.
Spark. That's an easy one to remember. And we did put a link in the comments here, investonmainstreet.com/book. So it's easy to click on. Promo code Spark.
There it is.
Just keep it easy.
Yeah.
And so everyone take advantage of that offer for a free copy of Patrick's book. Patrick, thank you again for joining us. We can't
Yes.
wait to have you back on sometime soon and hear about what you get into in 2023 and beyond.
Looking forward to it. Thanks for having me.
Thank
All
you.
right. We'll
And
see you guys
everybody
next
have a
week.
great Tuesday. Yes.
And
And
Happy
Happy
New
New
Year.
Year. Yes.
Happy New Year to everybody. Yep.